Good evening or good afternoon, depending on where you're at in the world. CROX just reported earnings today. I listened to the conference call. I reviewed the financials. I went through all that good stuff, did my little analysis, and I digested the earnings. And so we're going to talk about that. We're going to talk about what happened, how the conference call go. We'll do some financial statement analysis. And hopefully you learn a thing or two, get some value, entertainment, etc., and so forth. Hey, if you're a CROX investor and it's first time you're seeing my channel, consider subscribing, hit the thumbs up, because I'm always talking about CROX here and there. And yeah, so without further ado, let's talk about it. All right, so CROX, they reported before the bell, and consensus estimates for revenue was 880.88 million. They beat that, and they provided revenue, or they posted revenue growth of 6.2% and a 6.6% surprise from Wall Street analysts, from consensus estimates, and they actually posted 938.63 million. All right, not quite at that billion mark, but hey, maybe next year we'll get it. We'll get a billion that in Q1. So consensus estimate for EPS. All right, consensus estimate was 2.25, and CROX slammed that. So they did $3.02 in EPS. That represents 15.7% year-over-year growth and a 31.3% surprise. Let's go back to what management guided last quarter in Q4 of last year to what they were projecting this quarter to look like. All right. So this is last quarter, the quarter before this, Q4, and what they were posting for guidance for the next quarter was negative 1.5% revenue growth to 0.5, like half a point percentage of growth. So, and they were guiding 23 to 20% revenue growth decline, or revenue decline for the Hey Dude brand, and EPS of 2.15 to 2.25. So what happened was a sandbag. I got mixed signals when I got these results, and we were listening to the earnings call. And pretty much, I think the analysts that were covering this company probably felt the same way, because most of the questions on the earnings call was like, are you pricing in this capitulation, or are you pricing in improvement here or there? And I mean, you can kind of tell that the analysts were a little bit like questioning, like, what's going on? How come, like you were acting like you had a weak hand, but at the end of the hand, you freaking, when the cards were on the table, you had like a full house or something. I don't know, for all those that play poker anyway. But I mean, that's kind of the aura. That was kind of the aura of the actual earnings call with the analysts and so forth. And I think that might count against CROX moving forward, because these analysts will probably up their, they'll up their expectations, because they're catching on, like that CROX is sandbagging so much. So that moving on to that next point, what was the guidance that they posted for the end of year guidance in Q2? So let's go down here, bear with me. So this is what they're posting for Q2. They're expecting 1 to 3% revenue growth and 19 to 17% decline on Hey Dude, and $3.40 to $3.55 of EPS is what they're guiding. For end of year guidance, they're actually maintaining that same guidance for revenue growth and a decline. Actually, they're actually like their prior guidance for full year 2024 for the Hey Dude brand was flat to slightly up. Pretty much, it's going to take us a year to just fix the issue. Um, but with this new updated guidance, they're saying that it's going to take longer than a year to fix the Hey Dude issue. So that's something to consider. Adjusted one-time costs incurred more than expected. So they were guiding 10 million last quarter for full year outlook of 2024. This quarter they gave the update, hey, it's going to be another 18 million in one-time costs, and that's going to be that new tech system applied to the distribution center for the Hey Dude. Um, so yeah, I mean EPS is raised though. They're raising EPS, and that does not price in buybacks. Okay, so EPS may or may not come in even stronger than that. All right. Capital expenditures remain the same. I think that's very important. All right. So analysts were questioning the Q2 guidance outlook or the full year outlook. They're questioning the numbers to trying to get a gauge through management throughout the conference call. But management, I guess they held their own and pretty much dodged a lot of the questions and just said, "Nope, that's our guidance. Deal with it." Um, that's what I took from it. Now, let's look a little bit about some of the highlights that happen in the actual quarter themselves. So, we're seeing great international revenue growth. They mentioned that year over year, China and Australia, they grew triple digits in their revenue. So, there's a lot of great growth stuff happening in China. Q1 is the weak year. Q1 is the weak quarter where there's a lot of intense capital investment, a lot of maneuvering and stuff happening. So Q1 is really not you'll see in the financials what I'm saying, but yeah, to do 7% revenue growth year over year in the quarter, I mean, I'm happy about it, but honestly, I mean, I think that if a company sandbags, that's good. But to sandbag to the point to where you're saying like we're hitting major turbulence, we might have negative year over year revenue growth, and the best top of that range of the guidance that we're putting out is 0.5% of revenue growth, pretty much break even, and then to come in with a 7% revenue growth beat. I mean, I don't know. I mean, I understand the whole sandbag and then beat, raise guidance, sandbag from there, beat and raise guidance, but don't completely smash it. I mean, that's just me, but I'm happy with the performance either way. The EPS is good. I really like the EPS and the revenue growth, and they beat the better end of the Hey Dude brand guidance decline. All right. Um, so that's something to consider. There was no buybacks or debt repurchases, as you'll soon see in the financials. Why? Because there's no free cash flows for this quarter. All right. Some other highlights. There were some. How do you say? Collaborations. They had a Toy Story line that went out that sold out, so they did. That was good. And then they did there was a little collab with the NBA Seth Curry and some other NBA players were seen wearing some different new SKUs of different types of Crocs. Excuse me. So that's good. Um, and distribution center. I mean, there's some funky margin change stuff happening, but that's to be expected with the distribution center that was opened up. All right, so that's that. So let's talk about Hey Dude. All right, so they're saying there's more. There's still gray market pressure on Amazon for the Hey Dude brand. There's still some gray market sellers that are selling these shoes for cheaper. Crocs has raised the average price per Hey Dude unit on their direct to consumer website and on Amazon. So they're selling less units because there's other sellers that are cheaper on Amazon, which the company intends to just attrition all those out so that inventory will flush out and they'll run out of those shoes eventually. And also their brand building. They're going to introduce more products, but they're opening up 30 more specific outlets, retail store outlets for Hey Dude, and these stores are owned by Crocs. So that'll serve for more brand strengthening. This stuff takes a while. It takes a while to build brands, build brand power, and so forth, and be relevant. You know, you keep in mind Crocs is a really strong, as you can see. I mean, the Crocs brand revenues, they just keep growing and growing. All right, but Crocs is a known brand. It's been around 20 years or however long. Hey Dude's been around a few years. All right, so it takes work to build the brand, and Crocs is a master of that. Don't you ever underestimate. You think that this is a shoe company, but in reality, they're a shoe company that's better than most marketing companies. All right. So that's just my take on it. All right. So the Crocs brand continues to resonate globally with international growing 24%. So we're still, from an international perspective, we're doing double digits in the 20s. We're looking good there. And like I said earlier, Australia and China grew triple digits. That'll scale. They're opening more. They're opening like Crocs stores in China, and they're growing real fast over there. So as we get to scale, remember there's way more people in China than I'd argue anywhere in the world. So there is so much opportunity. There is enough. I bet. I mean, there is enough with international growth. There's enough international growth in TAM, which is the total addressable market, for Crocs to grow. I'm convinced maybe a couple more decades of just great growth in international to fuel growth. All right. So that's just my take on that. And that kind of reaffirms the thesis of my long-term hold. Um, so here's the margin outlook that they reported in Q1. Crocs margins increased. This is a gross margin, their adjusted gross margin. And as you can see, Hey Dude margin contracted. All right. It is what it is. They're still fixing the Hey Dude, and it'll be like that maybe into Q1 of next year. We'll see. I'm hoping that they're lowballing and then they've just fixed the Hey Dude and they're flat by the end of the year, but we'll see. All right. Let's move on to the actual financial statements. We'll talk about the good and then the bad and how I feel overall about everything. All right, so income statement. We'll go to quarterly under the financials and Seeking Alpha. You notice from March of 2023, where my cursor is, they posted that 884.2 mil. All right. And then March of 2024, they posted 938.6 mil. That's good. All right. Gross profit increased as well. SG&A went up. All right. Operating income went down. All right. We saw the increase in SG&A. It cost money for that new distribution center, and think of SG&A as an investment in their human capital as far as their workers, the distribution center. That distribution center is key to feeling more streamlined efficiencies and tailwind synergies. All right, we're going to see margin. There's going to be that distribution center is going to be very accretive to scaling margins. And what I mean by that is down the road, when we start doing, let me see here, on an annualized basis, we're looking at 4 billion in revenue a year. Maybe years down the road, 5 years or so, however long it takes, we're over here doing 8 billion, 10 billion, 12 billion in revenue years down the road. This distribution center is going to be able to further support that S curve in the manufacturing and the distribution and so forth. Excuse me. So that's something to consider. Short-term investments for these, and for long-term gain. Okay. Let me get down here. Let's go to diluted EPS and basic weighted shares outstanding. Slight increase, nothing serious. All right. There's some leadership changes happening. And if you look out from the past year's quarter, from Q1, it was the same thing. Basic weighted average shares increased by a point, a basis point, nothing. All right. Same idea on diluted weighted average shares. All right. And let me see here. EPS. I mean, we're looking good on EPS. All right. So let me see here. Bear with me. We'll go to the balance sheet. This is something that was pointed out to me that stuck out to me that wasn't really talked about in the earnings call, but okay. Like I said, they didn't do any buybacks, all right? But let me see here. Bear with me. Okay, notice here, total debt and net debt has increased, all right? So they raised a little bit of debt. All right, they went from 1.996.4 to 2.05.7 billion or what have you. Yeah, they increased some debt on here. They put, I think that's typical from their Q1. There's a little bit of debt that's added. If you look at the last Q1, there was also some debt that was added. Or wait a minute here. Let me see here. Yeah, there was some net debt that was added. All right. So nothing serious though. I don't think it disrupts the thesis of them just paying down debt and so forth. Cash flows. I saw that cash flows from operations went negative. They were positive from last year and they were negative. We saw about $27.6 million loss in cash from operations. However, but net income went up, and maybe there were some little cost synergies from taxation that may have helped that. All right, be not so much of a hit. Here we go. This is what I was looking for. Long-term debt issued 78.2. That 78.2 million was issued in debt, and they paid down a little bit of debt here. All right. It's long-term debt, so there's maybe some notes out there, or I mean, I don't know if there's credit facility or revolving credit happening for that. I'd hope not. And free cash flows are negative. Okay, so we went from levered free cash flows being negative 57 million to nearly doubling to a little over 100 million in cash flow loss. All right, so free cash flows per share went more negative. So overall, a mixed bag. To be expected though, because the management guided that SG&A would go up because of the distribution center. There's going to be, and it's expected that there's going to be some funky stuff happening with the margins. They're going to be going up and down and readjusting, but they'll get better as these synergies play out with the distribution center, right? Overall, the actual beat, the revenue, the combination of the revenue growth, actually the revenue growth overcompensated. I think a lot of it compensated for some of these different, different margin losses and stuff, to where the company was able to beat on EPS and revenue. So, and what is the result of that? Well, I mean, we look at the market likes it. At one point, the stock was like 10-11% up in the day or whatever, just starting out, and it sold off, and then kind of rebounded, and then we're up a little bit, 0.01% on the after hours. If you ask me, do I think that the stock should have sold off or went up? I think the shares are undervalued to begin with. So I think the shares are worth a little over 200 a share. Am I biased because I own the stock? Sure. Okay, sure. But here's my counter argument to it. The reason why I bought the shares was because I thought that they were worth over 200. So, I mean, you can take what you want from it. In fact, let's look at my position. All right. So we're up 35%. I bought 20 grand worth of stock. This is just a hold for me. Do I think that? Do I think it's possible that the stock can go down? Sure, but I think we've hit a new floor of actual support. So for this thing to go down under 100, for the EPS and the growth they're doing, that EPS yield and those free cash flows are kicking in, and it's going to be very hard for this thing to go under 100 now, I think. So I think the days of getting these shares under $100, I mean, that might be a thing of the past unless they do a split. So, but that's my take. Overall, I'm happy for the earnings. I think we might have to. I might have to relook at some of my projections for this year. I don't know. I think they might do better than their revenue guide, or maybe we see some turbulence in one of these quarters that, maybe that's why they're still being conservative, or they just don't know. But I know, long video, that's my whole take on the CROX earnings. I'm happy about it, especially with that juicy revenue and that EPS coming in. From a profit perspective, the company has outperformed for the quarter. From an actual financial fundamentals of the balance sheet and free cash flows, a little bit going down there, all right, but not that much. But that's to be expected in Q1. That's just how the cycle works for CROX, all right? So all in all, I'm happy about it, that they beat and stocks up. We'll see if that holds. I hope it holds. But yeah, I hope you all got value out of this. Smash that like button and consider subscribing to my channel. Thank you all for your all support. I love you all, and have a good day.